Good evening, everybody. Sorry about the silent movie that we produced last week. I didn't wear this. I never did recording the class before. Yeah. So hopefully today you will have some, nice sound from that movie. But as a remedy, I posted some videos that I recorded in the past. So if you missed something, you can look at those videos. Let me show you where they are. For week 1, there are 4 videos. Introduction video, the investment 101, and risk-free rate, equity risk premium. And each video runs about 20-30 minutes. So yeah, before it ends, you won't fall asleep when you watch those videos. But the video that we recorded for the class is like 3 hours. Yeah. You do need some patience to watch through the video. But anyway, I will try my best to improve the quality of the videos. Any questions when we get started? We have a newcomer, Jada, here. Jada actually missed the first week class because of registration thing, but right now she's here. Would you please introduce yourself to the class? All right. And Jada will need to join one of our teams for valuation project. So yeah, she will talk to you guys a bit later. Right. Okay, thank you, Jada. This week will be very stressful. I'm telling you. We have, let me see, 5 chapters to go through. This will be the most stressful week that you will experience in this course. 5 chapters. And during the class, we'll go through 2 chapters. A really big chapter, chapter 8 is a big chapter. And also we'll go through another chapter related to the growth rates. And I want you to go through 3 other chapters. Chapter 9, chapter 10, earnings, and from earnings to cash flow, there's chapter 9 and chapter 10. And a small chapter called the terminal value. Right? So I believe that most of you already read the chapter 8. So after the class, you need to spend a lot of time reading, especially chapter 9 and 10. Those are more important chapters. And we have 2 small chapters, chapter of the growth rate and a chapter of terminal value. And when you read the textbook, you really want to put a little bit more focus on those illustrations. Illustrations are examples, showing you how to use certain techniques, certain method to solve a specific problem. And if you have extra time, I really want you to practice those even number questions at the end of the chapter. You don't have to try all of them, but just to pick some of them to see if you can solve the problem like that or apply a certain method to solve that kind of problem. And if you have difficulty or doubts regarding, hey, what method should I use in this problem solving? Well, I would say the best way for you to figure that out is go back to the chapter. Look at those illustrations. Illustrations will give you a lot of ideas on what's the best method and what kind of procedure that you have to follow to fix that problem. And meanwhile, I want you to work on first exam questions. And if you need extra time, I think I can push the deadline for another week also, but I want you to work on those questions. After the first week, you should be able to address at least the 2 or 3 questions at the beginning. And then after today's class, you should be able to address, I think, almost all of them. Yeah, all of them. And some of problems need you to spend a lot of time to build up these spreadsheets, right? And some problems are pretty easy, like the first 2 or 3 questions are pretty easy, but you still need to build spreadsheets to show, okay, the process of your calculation. Right. Let me show you a great example of exam, take-home exam. Let me see. Week 2 or maybe week 3. I think week 3. Oh. Week 2. Okay, here, yeah. Yeah, this is a good example of the exam. It's a real work done by a student called Eric Darius. He was in the program several years ago, and he did a really good job in this course. And as you see, this is his solution to, let's say, the first question, right, in the final exam, 10 questions. So first of all, he actually spent time to reinstate the question itself. Right? Sometimes you can, if you have ebook, you can do a snapshot and put a snapshot here. But for the table, actually he reproduced the table in the question. Right? And doing this actually has an advantage because later on you will need to do a lot of analysis based on that table. So, I mean, anyway, you need to replicate that table. And then different question, A, B, C, D. Typically, a problem will have several questions for you to address. A, if you were valuing the company relative to others, then what's the average price to book value? And this cell is the answer, right? And it's not a number, it's a formula. So here's the thing, I mean, sometimes you feel, okay, it's too complicated to do Excel formula and everything. I mean, you can figure out the answer right away. I think that's okay, but as long as you get the right answer, you're fine. But if your answer is not, then you won't get any credit for that question. But even this number is not correct, but I see the formula, okay, he might miss something, then okay, this is good. 9 out of 10 or 9.5 out of 10. But if it's a number, but not quite same as the correct answer, then you won't get a credit for this, you see. And then I think this will also require the run regression in Excel. So there's another sheet showing the regression results, and then applying the results to do additional calculation like this. Price to book value equals a function of ROE, right? And those are estimates of the parameter. And those parameters are actually from another spreadsheet where he runs the regression. And for the first exam, you will have, I think you have one regression to run regarding estimating beta using market model. But in that case, make sure you know how to run regression in Excel. Right? So this is a good example. So make sure you spend a lot of time on exam and this problem solving by using Excel. All right. make sure when you show this Excel to other people like me, other people understand what you are doing there. Right? That's first thing, because everything that you do is for other people to look at. And the second, let's say you forget about this spreadsheet. You just put it in your computer, and let's say 2 years later, when you open this Excel, can you still figure out what you were doing at that time? I used to have pretty messy habit doing Excel work myself. So my problem is, okay, I did Excel sheet, pretty complicated one, but later on when I need to pick it up, I just cannot understand what was I doing at that time. You see, so here's a little value for you to make Excel look pretty, easy to understand, because you are going to use this in the future. And we'll build a lot of models, valuation related models, free cash flow model, this and that. I mean, each model contains many different details that you may remember or you may forget in the future. But with a good Excel spreadsheet, you know very clearly, right, to solve certain type of problem, what kind of method that you're going to use, what are in and outs that you need to pay attention to. Because this class is truly a detail-oriented class. It's kind of a training process. And you have to train yourself. Nobody like to address those detailed stuff. Nobody like that. And it's very time-consuming, right? But it's worthwhile investment for you to lift up yourself from amateur to professional. When you go to company, work a company, you're a professional, right? What makes your work professional is the capability that you can address all the detailed issues, while other people cannot. And I think it's a universal rule applying to all kind of money, not just the finance. And some people working in computer science area, they do like program coding, right? Pretty sophisticated thing, but for a lot of problems, college students can quickly figure out what kind of coding that they need to utilize, and they can figure out a solution to solve a problem. However, that solution is no good from a professional's perspective, because it doesn't address all kinds of issues on the boundary, on the corner, all kinds of dirty stuff that they didn't address. But it takes a lot of time for a professional to address all those detailed, dirty stuff. that makes you a professional. I'm telling you, yeah. It's a universal everywhere. If you want to deliver a good product, good service, right, to your clients, you really want to, try your best to address all the small detailed stuff. Of course, you have the big picture. Everybody has a big picture, right? And I think, the old saying is good. The devil is in details. Yeah. Okay, so that's exam, and I expect you guys to work really hard on your first exam. It's gonna be time consuming. First one's fine because I think 4 or 5 of those questions are very straightforward. Maybe 2 or 3 of those require to spend a little bit more time, but second exam is gonna be more time consuming. Right? So first exam relatively not that time consuming, but I expect you to spend at least a good 2-3 hours. Set aside 2-3 hours. Yeah, take time. Work on this spreadsheet. Look, I like the way that Eric actually lay out the structure of solving problem in Excel, and also like the way that he make everything look very neat. You see? For example, PV is in the middle of the column, right? Not just the one column. It's kind of consistent, right? And the color distinguish most important thing that he wants to show his audience, right? I mean, PBV, this is the most important thing that people need to look at it. And actually, I can click on each cell to see, okay, it is a formula. All right, that's exam. Any questions about first exam? I will check you guys next week when you come to the class. On Thursday, you should be able to, complete most of them. If not, I can give you a little extension. Yeah. No big issue at all. But I want you to work on those questions by yourself. It's not teamwork. You work on yourself. And I believe that you may find some kind of online solution. Even online solution is not 100% correct. It is not. You can simply copy and submit. But I think if you do that, you are wasting your money and the time that you spent in this class. All right? Because at the end, what you need from this program is not A or B, right? It's not great. It's a real skill that you can utilize in the workplace. And when a company interview people, they might ask you to solve a certain problem using Excel or other tools. Right? And even if you pass everything, but in the workplace, if you cannot do the work that they expect, well, then what will happen? You see? So take this as a great opportunity for you to run through some, painful process. I would say it's a painful process. First of all, it's time consuming. Second, it asks you to apply all the methods, things that we learned in the class in problem solving, and you need to address so many different detailed issues. It is a painful process, but it pays off really well. I'm going to tell you. Yes. And basically, nobody can get like 100% correct. Even when I solve those problems, I may miss this and that. And for a bigger problem, it may ask you to address at least like 10 different issues. But I may address like 8 of those or 9 of those just to miss the one, right? In that case, your work is still great. Your work is still great, right? It's typically 9.5 out of 10, maybe 9 out of 10. And if out of 10 required things, you only address like a half of them, I want to say your work isn't that great, but maybe 8 or 7. And for some problem, you just cannot figure out how to do that. You just, maybe 2 or 3 issues that you can figure out, but you just cannot complete the entire problem. That's okay. It's like a 6 or 7. Yeah. Just do this exam by yourself, take-home exam. Yeah. If you're in the same team, you might discuss a little bit regarding what kind of method, right, you want to tackle the problem, but do not just copy and paste, right? Copy paste. To me, it's fun. Giving grade to you guys is not a hard work for me to do, but I want you guys to get the valuable thing from this class. Yeah, it's time-consuming, painful process, but no pain, no gain. Yesterday, I went to Nashville. I went to a place called City Winery, pretty good restaurant, fine restaurant, and it's a CFA Society meeting, annual meeting. It's called Forecast Meeting. They invite experts, make a guest speech regarding the trend of the market, and also a great opportunity for CFA charter holders who work in Nashville areas and prospective CFA candidates to learn more about this industry and network with professionals. And I think in this financial industry, in addition to your degree, right, you probably want to get some kind of certification. Right? Like a CFA is a globally recognized certification. And in the Nashville, I think 10 years ago, there's about 200 charter holders, but nowadays, man, it's exploded because UBS moved here, And a lot of other big companies moved here. I think 3 years ago, a big asset management company called Alliance Bernstein. Alliance Bernstein moved to Nashville. And actually, the CEO of the company actually made a speech last night. Yeah. And so a lot of people are CFA charter holding. A lot of people are working on getting that certification. And during the meeting, they recognized the 15 people who actually got the CFA certification. Yeah, it's a kind of high note for their career because it's not a required thing that you had to have to get into this industry, but in the long term, you really want to get it because it's kind of a golden certificate showing your boss, your clients that you are a very competent person to handle that business, and you are a honest person, right? Stick to the higher ethical standards, so your boss can trust you and your clients can trust you. I mean, in the financial industry, what's the most important assets? Yeah, you got it. Bingo. It is the trust, right? It takes decades for company, for individuals to build up the reputation, right? To establish the trust relationship between them and their colleagues and their clients. But typically it takes just overnight bad things to just ruin the entire thing. So the trust is the most important thing in this financial industry. I mean, it's not like other industry. I mean, other industry have factory, have building, have equipment, right? But in the financial industry, it's simply the trust, right? And there are several ways you can work on this trust as you prepare your career, right? One thing is do great work in the college and in the graduate school. I mean, employer they interview you, they look at your personality, take a look at your skill, they look at your transcripts as well. The people who have higher grades means they work hard, right? And I'm not a believer that certain person is smarter than the others. I do not. I believe that most people have very similar level of intelligence level. It's about equally smart, right? Just in different areas. Some people may be more competent in certain area because he or she actually practiced more in that area, right? And I think it's all about hard work. Yeah, even if you are smart, you still need to work really hard. Yeah. So that's a little extra comments. So if any of you are interested in this CFA thing, I think I suggest you to look at, let me see, it's on the home page. There's a lot more information you can learn, right? To see if CFA is something that you really like to get in the long term. You don't have to get it just at, I mean, it's a 3 level of tests. You take the first level first. If you passed it, then you move to the second level. Typically 1 level for each year. So most people spend 3 years to get this 3 exams passed. And then they need to have, I think, 3 years of relative working experience and a recommendation from charter holders to get this charter. And each exam lasts about 8 hours. It's a 1-day exam. It's not on computer. It's a paper-based test. And the testing sites, Nashville has one testing site. Atlanta has one. Charlotte has one. I'm sorry? Yes, of course. They allow you to eat lunch. Yeah. Yeah. Yeah, the test itself is kind of I would say, I mean, This exam actually tests you mentally and physically as well. Right? And so they want to see, okay, first of all, you are knowledgeable about everything they want to test, and the second, you have a very strong body, right? You can handle an 8-hour test, right? And and to prepare for the test, typically people spend 300 hours of high quality study time. Yeah. And none of those questions are very, very difficult. None of them. In terms of difficulty level, I would say most questions have difficulty level between 7 and 8. Yeah, that's all. However, it tests very comprehensively of everything that you learn in the college or in your graduate programs. Economics, statistics, of course, all the things covered in your finance classes. Yeah. So after, typically a student should be able to take level 1 test and the graduate from the college. And then after working several years for the company, then you take a second level and then third level. Some people take I know yesterday there's a CFA Society officer. Actually, he told us that he took the 9 exams to get the charter. 9 exams means how many? 3 levels, 9 exams. So he failed like twice for each level. So on average, you took it the first time, it failed, but you try second time, still failed. You try third time, you passed. Something like that. Yeah. 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 So, yeah, it's something. This exam itself actually, yeah, it's another training it's like a self-training program. Yeah, train yourself to be knowledgeable about most things that you needed to know as a finance professional, right? And go a little deep in terms of different topics. Yeah. Special topics like fixed income, derivative, active valuation, but everything is kind of covered in a typical master program. Yeah. So that's little CFA information. And if you decide to take on CFA test, let me know. I can help with scholarship. Yeah. I can help. I think I'm able to do, let me see how many. 5 each every year, 5 scholarships each every year. Yeah. For MTSU, yes. If we have more than 7 requests, I may ask help from the CFA Society of Nashville. Yeah. Right. So that is additional issue. Okay, let me ask you one question. Have you ever picked the stock that you wanted to do for your valuation project? What is the stock? Shutterstock. What's the symbol of it? S TK. Okay. Shutterstock. All right. I like that. First of all, I don't know what this company is. Market cap 3.27 billion. Yeah, it's a very typical small size company. Yes, I like that. So here, once you decide which company that you want to analyze, then it's time for you to get more information about the stock. And the thing that we learn in this class is just to offer you guys a huge toolbox. All right. And there are so many different compartments. Last week I offered you 2 compartments. The first compartment is for risk-free rates, right? Second one is for active risk premium. And in the compartment of that risk-free rate, you have 3 tools, right, to address domestic risk-free rate, and another 3 or 4 tools to address foreign risk-free rate. And so once you complete this class, you will carry a huge toolbox that can help you to fix virtually, I would say not 100%, but more than 90% of things that you need to deal with in your future finance career. Right? And right now we have a real thing for you to address, that is to evaluate a real company. You have all the tools, right? But having tools is not enough. I do woodwork. I need the wood. You do valuation. You need some real meat. The real meat is not in the book. It's not in PowerPoint or video. You need to find the meat by collecting financial information. So first place that I want you to go is Yahoo Finance. It's a very easy place that you can get more understanding about a stock that you're interested in, such as SSTK, right? And here you can find a lot of things: stock information, company outlook. Okay, you need the money for that, but ignore that. Price chart, statistics, right? Some simple numbers, right? Give you some overview about the company, the historical data, and I think Yahoo Finance covered 3 years historical data for financials. And that is historical data for stock prices. And for financial numbers, cover 3 years, 18, 19, 20, annual number, and also you can check quarterly numbers, so on and so forth, balance sheet, income statement, cash flow, very simple, right? Main financial statements, and some analysis, other people's opinion, right, regarding revenue, earnings, right, buy or sell recommendations, so on and so forth. So from here you will get a lot of very basic information about the company. And another thing that I want you to keep eye on is the general market condition, right? If you go to Finance Yahoo first page, you will see a lot of news, right? Stock indexes as well, some key financial indicators such as 10-year T-note rate, right? Even gold price, oil price, index, so on and so forth. And right now, index doesn't look great right now. S&P 500, right? That's market benchmark, and you can look at a year to today. It's no good. Right? 4,800 level down to 4,300 level. It's already lost more than 10% of it. Right? Then, I mean, through a phenomenon, you want to figure out why is that. I mean, here, I mean, during the pandemic, the pandemic, there's a dip, right? Pandemic, but after the pandemic, it kept rising, right? So you might want to think about, okay, why? A lot of whys. And right now it's declining. You want to think about why. And you do need to pay attention to those macro level things, such as stock market trend, right? And the second, the Federal Reserve, people call that the Fed, right? They have an influence on interest rates, and interest rate discount rate for valuation, of course. That's a very, very important thing for you to pay attention to. Federal Reserve. So you want to check news about Federal Reserve periodically, right? It looks like they are about to do something. That's why markets get off that.
They already did yesterday. I was reading the report. They didn't have the limit on the repos, and because they used to hedge funds usually the banks, so they can have no way because hedge funds they have enough money, and banks they don't have enough money.
Yes.
Enough money when
I see.
And they're not willing to do that on a 0.25%.
Uh-huh.
It doesn't make sense risk for them. And the Fed was loaning that money to the banks. Right now, that capped that to $500 million per institution.
I see.
And today the interest rate on 10 years was already 185.
Uh-huh.
So the curve is starting to.
Yes, absolutely. You really want to keep track on what the Federal Reserve is thinking and what they're going to do. I mean, they made it public they're going to raise the interest rate in March, right? and they're already doing something. But typically, Federal Reserve actually wanted to do something to tackle inflation rates. Inflation doesn't look good. That's why they want to do something, right? Tighten the money supply, raise the interest rate. That's the main way they can do to fight against inflation, right? So that's why market is scared, right? Think about in your valuation project right now, you should be able to build up that risk-free rate. Right? You need to get the cost of equity for this company, right? Risk-free rate plus beta times market premium. Right? What risk-free rate are you going to use? Right? Think about that. 3 methods. Right? What equity risk premium would you like to use? Right? That's another question for you to address. But once you pick a number, you really want to give some supporting argument. Here's why I choose this number instead of that. And other than this Yahoo Finance, or maybe Google Finance or CNBC, where you actually keep track on those financial news, Federal Reserve, federal government, right? Sometimes some political things can have huge impact on financial market, but those financial website or channels are a great place for you to keep an eye on. And then another place is Capital IQ. Anybody in this class do not have a Capital IQ account? So all of you have one?
I'm not sure.
Okay. It's through MTSU. You use your MTSU student email address to register account. So once you get into the account, you can check the financial information about the company that you are going to analyze, right? And here's a SSTK, and you will have more than what you need. Right? Typically, you want to look at financial statements, and then you want to do some ratio calculation, right? But here, once you have this data set access, you don't need to do any calculation at all, because they did all those ratio calculation for us already. And what you needed to do is to look at it, to interpret the meaning of those ratios. Right? And typically you want to look at the financials and the valuations, right? Balance sheet, cash flow, income statement. For example, income statement, right? And by default it shows 6 years, but actually you can make this as long as you want. You see? You can use this bar to make it longer or shorter, right? Or you can look at seasonal patterns through quarterly report, and this is the annual report. You can also do quarterly report as well. And the most recent on the left. In the most recent quarter, third quarter of last year, they haven't reported fourth quarter results yet, but it's coming. Yeah, it's coming in February or March, as late as early April. That's where company released their annual results and the fourth quarter results of last year. And regarding annual results, I think the most recent one would be 2020. Because 2021 is not available yet. And you can look at the balance sheet, you can look at the cash flow, and you can look at the ratios. It's all calculated. February the 10th, they're going to release earnings. Okay. And so from here, when you have those financial information, you can do so-called historical analysis. Historical analysis simply compare this year or this quarter results with previous years or previous quarters performance. And other than this historical examination, you also wanted to do horizontal examination.
You want us to download
You mean, yeah. You just go to capitaliq.com. Yeah. I already logged in. Or you can go to MTSU. Of course. It's just a website. It works everywhere.
You want to do
The Excel,
the Excel sheet with the template from the capital to do the future cash flow analysis, something like that, discussing the cash flow.
you can use it as an add-on in Excel.
And then you can go to library first.
I have it on my laptop. I can try and see how I did it. But I know it's added.
And then database. It's called Capital IQ Net Advantage. And then you can log in from here. And difference is, I think previously, the difference is that if I log on through the library, I will have access to individual stock research and industry analysis as well. But if I log on directly through the website, it doesn't show up. Yeah. So, yeah, from SSTK, I mean, for smaller company, we might not have the research report ready. Yeah. For large company, I mean, S&P do research. They have research report on that, but for smaller company, no. And let me see. Yeah, you can find research, investment research, equity research. Let me see if there's any. Okay, no. They don't cover this stock, yeah. And then you can look at industry survey. Industry survey is industry analysis. So it analyzes an industry with a lot of competitors, right? And here at a certain point, you want to compare this one with its competitors. Let me see. It's called a peer analysis. Peer analysis is to compare this company with its competitors. And actually, when you click on this, you will see some nice table. Yeah, already built for you. Yeah. Shutterstock versus its competitors. Yeah, not just the one. Yeah. 10 of those. Yeah. And there's some key statistics. Yeah. Very convenient. Very convenient tool for you to do financial analysis and this peer analysis. And all those analyses serve the goal for you to get great estimation of those key inputs. So your model will generate a good estimation of the stock price.
They also have a template for the Excel.
Uh-huh. Uh, you needed to start with your own model and look at which input that you needed to get a more precise estimation regarding certain financial matrix. Yeah. I mean, you can download those things, yeah, using the Excel function here. But when you do downloading, you will get way much more thing that you need. I think when you go through this database, you really want to collect the thing that you need. They will show you everything. But you pick the thing that you need the most. Absolutely. You can download and clean it. Yes. Yes. Yeah, typically I download a big table, then I pick certain items. Yeah. So this is a very convenient tool for you to do financial analysis. Yeah. It's called Capital IQ. So Mac doesn't work?
Now, the out doesn't work. Oh, so, yeah, we had an issue with that. So,
That's what I was talking about. Like, it
yeah,
didn't work.
no more than VCL, unfortunately.
The extension, the Excel extension doesn't work with it.
I see. Yeah, sometimes Mac's kind of annoying. When they use Microsoft thing, Microsoft doesn't want Apple products to have convenient functions in the Office suite. That's understandable. Yeah. Okay, chapter 8, a big chapter. All right. Why chapter 8? Well, first thing is to get this discount rate. Stock price equals dividend divided by R minus G, right? That R is, I would say, most important thing in your valuation framework, right? And then R, cost of equity or required rate of return equals risk-free rate plus beta times equity risk premium. We fixed this. Risk-free rate, equity risk premium. And now it's time for us to fix this beta. And also this chapter 8 talks not only required rate of return of equity, but also the cost of capital, or weighted average cost of capital, and the cost of debt. So after this chapter, we should be able to get all the tools that we needed to estimate those discount rates in your financial valuation models. All right. That rate could be cost of equity like this, if you do dividend discounting model. And but sometimes you need cost of capital. So you can utilize free cash flow to the firm model. All right. And so to get the cost of capital, of course, you need this cost of equity, but and cost of debt. And how to put those things together in the formula cost of capital. So that's chapter 8. It's a big chapter. A lot of problems for you to solve in your first exam. But I think the tricky thing is all about levered beta, unlevered beta. So I summarize the tricky things here. Those are things that you wanted to practice a lot, right, in your first exam. Right. Before we get there, let's talk about 3 big tools that you can utilize to estimate beta. By the way, what is beta? Beta is here, right? But what actually beta mean?
Mathematically, that's the angle we intersect our market. So, well, from the polynomial of the first grade, there's going to be
I see.
plus E, well, multiplied by X, that's going to be
Absent. This beta measures risk. It's called market risk. And this risk is measured in a relative way. It's relative to market. So if beta equal 1, that means it has same risk as market. It's more risky than the market, beta greater than 1. If less risky than the market, it's less than 1. It's kind of relative measure, right? And it's a theoretical, it's once again theoretical thing, right? It measures so-called market risk, assuming small investors hold portfolio, right? So unsystematic risk will cancel off each other, but what's left here is the market risk of beta. And for beta, we have three tools to do our best estimation. And nowadays, most people rely on the first one, regression beta. Regression beta, by using a market model. But somehow you will find this beta estimation is no good. And I'm going to tell you why not. Why it's not good. In addition to regression beta, you wanted to utilize, as a professional, you wanted to look at service beta. Service beta actually did a little adjustment based on mean reversion feature of beta. By the way, when you put beta here, in this beta in the past, or the current beta, or future beta.
That's what we have based on the past.
What we have through regression is beta in the past. But in the equation, this was supposed to be the future beta. All right? So keep in mind this regression beta showed you past beta, not the future beta. If you use past to forecast future, it's okay, right? But keep in mind, it may not correct. Right? And beta changes over time, even for the same stock. It's time varying variable, right? Changes over time. And over time, people find that beta has mean reversion feature. Mean reversion means when beta is higher than 1, then it has tendency in the long term to move down towards 1. If beta is lower than 1, then over a long time period, it has tendency to move towards 1 as well. It's called mean reversion feature. So most service beta take that into consideration. Right? It's kind of improvement upon this regression beta. But anyway, this market approach is based on what happened in the past, trying to forecast what will happen in the future. In some cases, it's not reliable. It is not. Why? Because this financial market is like a river. Every time we step in the river, it's the same, but actually they are very different. each every second, you can say this is the same river, right? Mississippi River. It's always called Mississippi River. But every every second is different because the water will going through certain spots, they are totally different. Right? The waves are different, temperature different. It's different water. Right? So this beta is like water. The same river, but different water. So what can we do? What can we do about beta estimation? Well, here's another way that we handle estimation. We look at fundamentals, the real thing that affect beta. So first of all, we are going to dig a little bit deeper to see what are sources of risk. Once we understand the sources of risk, then we can do some better estimation. If we understand the source of risk and we incorporate that source of risk into our estimation, we call that as fundamental beta. We estimate beta based on business fundamentals that we can figure out through our analysis. So that's a fundamental approach, also called bottom-up approach. Bottom-up means we look at the fundamental from the bottom, right, and go up, trying to estimate the beta. And the last one is accounting approach. We use accounting data to assist our estimation of beta, which is the less popular method because accounting look at the data frequency. On the financial market, you have daily data, right? Minute to minute, second to second, but for accounting, it's quarter to quarter. Unless you're estimating long-term beta, this accounting approach is useless. You see, there's only 4 observations for a year. When you run regression based on 4 observations, what can we say, right? Unless you do like a long-term beta estimation, 10 years, even for 10 years, you only have 40 observations. But why do you need a long-term beta? See? Beta is a time varying variable, right? So accounting approach, another perspective, useful perspective, but not that popular at all. But still we have 3 different approaches for estimating beta. So first of all, regression. Let's run regression. Regression is based on market model. We run regression of individual return of the stock against the return of the market, typically S&P 500 index. Right, so you have a series of individual return and a series of S&P 500 index return. It can be daily data, right, for the last year, 250 days, 250 trading days, or you can do 500 trading days, right, covers 2 years, or you can do weekly, so one year has 50 weeks. You can do like 100 observation for 2 years, right? 150 for 3 years, so on and so forth. But anyway, you have 2 series of data here, and then you run regression. Right? So when you run regression, you will see alpha and beta. Alpha is the intercept of that regression line, and this beta is the slope. And this beta slope is the estimation of beta. It measures the relative riskiness of an individual stock against the market. So that is regression beta. And regression beta, in practice, in theory, it's a sound theory. It's based on capital asset pricing model. But in practice, there are many details for you to address. First of all, what's the best frequency of the data they're going to use? Would that be daily, weekly, or monthly? And the second, how long that data should cover? Should you cover the last 1 year, or last 2 years, or last 10 years? You see? And the third question is this market benchmark, S&P 500, of course, represents the largest stock. But if you want to truly find the benchmark for entire market, then you might want to use like a Russell 3000 index or something like that, right? Or market composite index, something like that. So there are many different issues to deal with when you apply this model. And when you run the regression, okay, first of all, you need to understand the meaning of those statistical references that you get from the regression results. Regression will give you this alpha and the beta. And you know this beta is estimation of beta. It's for the past. Right? If you use 1 year, that's 1 year beta during the last year. Yes, sir.
So for doing the specific analysis for the certain stock, do you account for the volatility index when they calculate that?
Volatility index, that's volatility index is for the entire market.
Yeah, but the question is, whenever you do the investment, because technically the higher the volatility, the riskier it's getting fast.
Yes. But that's the entire market. But this beta goes with the market. It doesn't matter. You see?
Because you live in that's systematic risk with the market.
It's like this entire market is a big boat. And you sit in this boat. Relatively, no matter how this boat drifts, you don't feel any movement against this boat. So that's what beta means. Beta is relative movement between you and this boat. If you walking on the boat, okay, you see the movement, right? No matter how this boat moves, you see. The volatility index measures the entire market volatility. Yeah, but beta is kind of relative. That's why I highlighted at the very beginning. Right? This beta is relative risk measurement against the market. Right? And in addition to a lot of small issues that you need to fix, this beta has certain limitations. First of all, this beta estimate may not be statistically significant. You need to look at standard error and the t-statistics, right, to see if this beta is truly distinguishable from 0. Sometimes, okay, let's say the t statistics only like 1.2. That means this beta is basically 0. Your regression yields nothing. It could be positive 2, it could be negative 1. Right? And let's say your t statistics approach like 2.01. Well, I would say 90% chance this beta is good. But still you have 10% chance this beta may not be good. Yes. Okay. Lower boundary versus higher boundary. So it's a standard, let's assume standard deviation, right? And this beta estimation, let's say 2.0, right? And make sure, okay, 95% of confidence, this is the 95% confidence level. This one will not be less than 0. It really depends on how big this standard deviation is. Yeah. And this is a kind of two-tail test, 2.5% on each side. That gives you 95% confidence level. Or people do at least like 10%, right? In total on both ends, that's 90% of confidence level. The thing here is this beta may not give you 90% confidence level. That's what this high standard error means. This beta may not be statistically significant. Right? And the second, this beta is past beta. In the future, if the business mix of the company changes, then this beta is useless. And the third one is this beta reflects the past financial leverage of the company. If in the future company has different capital structure, then this beta is once again useless. So anyway, this beta reflects the fundamentals in the past. In the future, if you have different business fundamentals, the beta is going to be completely different. So that's the limitation of regression. Regression is kind of a looking to future, right? But things could be different. It's the same river, but the water is different. And here's additional thing about the regression, that is alpha. The relative relationship between alpha and R times 1 minus B actually measures the actual excess return of the stock. And in addition to statistical significance of alpha and beta, we also want to look at R squares. R squares measure the overall fitness of the regression itself. And typically, people are looking at R square greater than like 10%, 20%. Some people say, hey, how about 90%? That's not realistic for you to run this market model, because a lot of finance research show that if they do run long-term beta regression, they already include other factors. In addition to beta, that R square is only like 20%, a little less than 20%, 10%, something like that. Which means in this case, this beta can explain less than 20% of stock return variation. It is an explaining factor, but not as powerful as like 90% explaining power. It's not. It is not. Right? So those are all weakness and limitation of beta. Keep in mind, because nowadays, especially for college students, when they're trying to get an estimation of beta, they just do market regression and take the data as beta estimation. But at your level, you needed to know where is the limitation. I mean, it's useful. It is useful, however, it carries a lot of limitations. Sometimes what happened in the past could help you to forecast in the future, assuming those business fundamentals are similar between past and the future. Assuming. But somehow, things could be very different. You see? And also, statistically speaking, this beta may not be that reliable at all in your regression. Like its statistical significance and the fitness of the entire regression model, reflecting R-squared. So this is a regression beta. And if you go to Yahoo Finance, you might be able to find a beta of the company. SSTK. They have beta 1.8, 5-year monthly. Okay, they tell you how long is the data to cover in the regression and what's the frequency. They use monthly data, right, for 5 years, and they run the regression, and it shows beta is 1.08 for this company. Can you use this number? Some people just plug this number into their model, right?
We can go to Google Finance, and you will have a different number because that's Morningstar and then Google Finance. I don't remember. But that's going to be
Yes. And sometimes you wanted to ask, why do I need this beta? What's the purpose of your valuation? And some people say, hey, I'm forecasting stock price in 12 months. In this case, if you use 1-year data, that'll be fine. If you are looking into a longer term stock price estimation, 2 to 5 years, I mean anything beyond 2 years is kind of a long term on the stock market. You probably want to use a longer time period. Let's say 2-year match 2 year. 2 year in the past to match future 2 year. And here, to me, it looks like you are trying to match what will happen in the next 5 years. If you use a 5-year data.
For our project, you want that we make the regression. That is what you mean. So we collect the data from the data, make all the. I don't know how to do it, but I know that what you were saying, you don't want that we copy that number into our calculation.
Yes. Yeah. Yeah.
For example, let's imagine that right now we're living in a economy that's moving up, and that's not moving, it's going down, and that happened before already. One of the things how we can determine, we can look at the average PE or price to book value ratio, and then on all that historical information, by looking at the trend of the actual slope of the market, can we do the weighted data? For example, make assumption that market chooses the direction at some point, and at some point it's going to move sometime in that direction based on the price to earnings or price to book value, because that's a fundamental. And if we're an overinflated market, I would pay attention less to the information that during the overinflation, which was abnormal. Pay more attention, devoting, for example, for 1 year valuation to the time when this whole thing happened before, and the price to earnings, or price to book value was relatively the same. So I would use the data based on that.
Very good question. I think we will get into that P ratio, PB ratio a little bit later. It's two different systems, and right now we are trying to get this discount rate fixed so we can get cash flow model works. And after that, we'll do P ratio, PB ratio, that kind of financial valuation multiples. But at the end, you will recognize that two different systems are exactly the same regarding the fundamental factors that we need to consider. Even for P ratio, I will show you a formula, right, that contains some business fundamentals, like growth rates, ROE, like payout ratio, so on and so forth. Those are fundamentals, right? P ratio itself is kind of consequence, right? Price is a market consequence. Then divided by earnings, right? Earnings is a fact, but the price kind of opinion, right? But still, within that opinion, you will see a lot determinants, business fundamental determinants. And those determinants are the same, although you are using two different systems. But we are not there yet. Yeah, I think I can answer your question completely after week 4, after we complete that book, valuation multiple chapters. Right. So right now, we are at this beta, and a different company, they do use different methods estimating beta. Yahoo Finance has one, Bloomberg has one, Morningstar has one. Which one will you use? No matter which one you use, those companies actually offering so-called their estimation of beta, and we call that as service beta. Right? If they offer professional service, then why don't you use it? When you use it, keep in mind that okay, those service betas are adjusted by incorporating the nature of mean reversion. And here's how they incorporate the mean reversion feature into that adjustment. So through regression, they will get so-called raw beta estimation. But they only attach certain percentage to this raw beta. And they apply the rest of the probability to just beta equal to 1. So that if your beta is less than 1 as raw beta, your service beta will be a little higher. If your raw beta is greater than 1, then your service beta is going to be lower than that number. So it's kind of a downward adjustment considering this mean reversion nature of beta. So there's nothing wrong using service beta or regression beta, but I think if you are a great financial analyst, you really need to know the ins and outs of beta. Right? I mean, regression is kind of a backward-looking thing. You see? This is the order count of the market. This is order count of the market. It's order count. Order count versus order count. You get some kind of estimation. Right? But regression doesn't reveal you the most fundamental thing about risk. About beta. I mean, beta is risk, right? The thing that we use to measure risk. And in this regression, I mean, is there any risk? Anything look like that? No. It's just the consequence with the consequence, relative consequence, reveal the relative risk. And another way is for you to, forget about consequences. Let's look at the fundamentals. Let's look at the causes first. All right? What are rooting causes? What's the root causes for risk? So there are 3 sources of risk. Those are determinants of beta, determinants of risk in a company. 3 different types of things. The first one is the nature of the business. If it's a cyclical business versus defensive business. If the cyclical business, then it should be more risky. If the defensive business, right, it should be less risky. For example, Walmart is kind of a defensive. It's in the defensive industry. The risk is much lower because when economy goes down, they do better. When economy goes up, they do worse than other businesses. You see, so the volatility is much smaller. It's called defensive. So if your company is a defensive industry, you're supposed to have low overall business risk, right? So that's the first determinant of beta, the types of business. And the second source of business is its operating leverage. Operating leverage is measured by the ratio of fixed cost versus variable cost. When you compare two companies, one company has higher percentage cost that is fixed, and another one has higher percentage cost in variable cost. And actually, a company that has higher percentage in fixed cost is more risky. That explains why nowadays a lot of large companies, they do outsourcing. Outsourcing means they are converting fixed costs into variable costs. In that case, overall the risk can be reduced for those large companies.
I have a question. For example, even in one industry, technically, if one company is constantly hedging their variable costs, they will have the lower beta, right? For example,
Yes.
Southwest, they buying futures,
Yes.
and they constantly profitable because they know what they're going to get the actual value. Delta, they never do that,
Uh-huh.
and they prices all over the place. So even in one industry, just by decision the company makes, they can have a completely different beta, right?
Absolutely. For airline company, most airline company used to use futures contracts to hedge against oil price. However, after 1980s, most of them abandoned their practices. Why? Why is that? Because in order to hedge against oil price in the futures contract, airline company needed to take what position? Short position. And on the oil futures market, it's very easy to be squeezed. It's called short squeeze. So when oil price is going up, your hedge position will broke because any company has limitation on how much cash they have to hold on to their hedge position. So during early 1980s, a lot airline companies actually lost a huge on the futures market because their hedge position is kind of vulnerable to the margin calls. They don't have cash to deal with the margin calls. So margin calls ask one company, hey, you need to put in $2 billion US. Otherwise, we have to cut your position. Because right now, oil price temporarily goes crazy. In the long term, they will go down. But short term, they are going crazy. And you do not have money to address margin call. And you have to make loss realized. So, companies actually, they learn lesson. So most companies no longer using futures to hedge against oil price risk. Instead, they let it float, let consumers to take the risk. So when oil price increase, they raise the ticket price. It's easier. It's much easier. So let the consumers take the risk, right? Because if the airline company to hedge the risk, it's too risky for airline company to do that kind of hedging because this margin call thing. Yeah, very good thoughts. So 3 sources of risk. Second one is fixed costs versus variable costs. If a company has high percentage costing fixed, then it's more risky. So the application here is, okay, you get this beta, right, from last 5 years. During the last 5 years, company had high percentage costing fixed, but right now they are doing outsourcing, right, and they are lowering the percentage of fixed cost or lowering the operating leverage. In that case, you know this beta is going to be low in the future because the operating leverage will be changed. Right? So this is the advantage of using fundamental beta. Fundamental beta give you flexibility to address the real things happen in the business that affect the risk. Right? And the last thing is financial leverage or financial debt ratio. That is the most important factor in determining beta of the company, because over time company may have different capital structure. Therefore, beta should be different, right? When a company borrow more money, company tend to be more risky. Your beta is supposed to be higher. Right? So here we have this very fundamental equation revealing the relationship between levered beta versus unlevered beta. So what is the levered beta? Levered beta is the beta after company take the leverage, take the financial leverage. Unlevered beta is the beta assuming company has zero debt. Assuming. Right? If company has no debt, then what the beta should look like. That is the levered beta versus unlevered beta. And the levered beta definitely is greater than unlevered beta. Right? And here is the adjustment factor. 1 plus 1 minus t. T is the tax rate, and D is debt, E is equity. It's debt to equity ratio. So higher this D, higher the levered beta it will be. Or higher the debt ratio, higher the levered beta it will be. And actually you can flip this equation over. If you know levered beta, you can figure out what is unlevered beta. So this equation addresses this degree of financial leverage in determination of beta. And for this operating leverage, it's this equation. So yeah, here we avoid to use this levered again. We use business beta. Right? Business beta equals unlevered beta times 1 plus fixed costs divided by variable costs. So to consider the operating leverage in determinants of beta. It doesn't look very complicated, isn't it? And here's a big picture about 3 sources of risk that we should consider when we estimate beta from this bottom-up framework, or so-called fundamental beta estimation. We look at business fundamentals, right? 3 fundamentals. The type of business, cyclical or non-cyclical. Second fundamental is operating leverage, fixed costs versus variable costs. And the last one is the debt ratio or financial leverage. It is those 3 things determine the overall level of beta. And it's time for us to look at some examples. I mean, you have to look at an example to see the full procedure of beta estimation. So let me switch to document camera so we can see the example of 8.3. Let's do 8.3 first. It's estimating Boeing's Boeing's beta. And here we have historical debt to equity ratio, 15.55%. And we know that in the future, Boeing will change that debt ratio significantly. Therefore, our beta from regression is not reliable. So, first of all, from the regression, we see that beta is 0.56, with the current 15.56 debt to equity ratio. So from there, we wanted to know what is unlevered beta first. So we know levered beta from the regression, right? We know the past that data structure. So we want to figure out what is unlevered beta. What's the beta if Boeing has no debt in the past? Right? Through this equation. Actually, it's a flip over. So raw beta is 0.56 and unlevered beta would be 0.51. 0.51 is the beta assuming Boeing has zero debt. Right? And now we know that that ratio will change in the future. For the next 5 years, that capital structure can be totally different. Let's say there are two scenarios. First scenario, debt to equity ratio decline to 10%. If that is the case, we apply that into the equation. All right? Levered beta equals unlevered beta 0.51 times 1 plus 1 minus t times that ratio 0.1. If the debt ratio increased to 25%, then we plug this number in the equation like this. And you see the beta estimation are different based on different data structure. And based on the current debt structure is 0.56. If that ratio declines, it should be 0.54. If they increase, then it would be 0.59. So here it reveals the relationship between beta and financial leverage. And here you can do other calculation, right? And this beta right now is like in the neighborhood 0.5, 0.6. But if this debt to capital ratio changes significantly, it can go really high. It can go really high. If he have more debt than equity, that ratio is going to be greater than 50%. Oh, I'm sorry. Here's debt to capital and here's debt to equity. Let's say 1.5.
Yeah, 1.5. And then on that equation, instead of 20, we put in 1 point something.
If debt equity ratio assuming 1.5, that means debt account for 60% of entire capital, 40% of those are equity, you see.
Okay, I got it.
Yeah. There are a lot of companies that have more debt than equity, especially for banks. Banks have, for each dollar of equity, they have like $10 of debt. It's highly leveraged, right? And Boeing has pretty low debt ratio. So here you see we use this unlevered beta as a bridge to link the past levered beta to future levered beta. And we use this unlevered beta as a bridge to do the calculation. And you will use this method for many times in problem solving this chapter. Use unlevered beta as a bridge. Right? And let's take a look at another example. This is a great example for so-called build up or bottom up beta estimation based on fundamentals. Illustration 8.4. The company is Van Shoes, and we want to estimate beta of this company. How? This company, let's say it's going through IPO maybe? Yeah. It's not tradable yet. If it's not tradable yet, how can you find beta? Through market model. There's no way, right? But No problem. No problem. Let's take a look at a fundamental or build-up approach to see how we can estimate beta for a company like that. So first step is to find the Van-Shoes competitors that is tradable on the market. You find a benchmark, not just the one, many of those, 10, 20, you name it. And actually we have like a couple dozen of those companies here. And of course they have different beta. All right? And they have different debt to equity ratio. They even have different tax rate. And different operating leverage. Different operating leverage. So this is the market data we can get. That's the benchmark for us to start our work estimating beta for Van-Shoes. And from there, you see the average beta of shoe manufacturing industry, 0.75. And also you see average debt to equity ratio, 75%. So with average tax rate 25.95%, we can actually figure out the unlevered beta for an average company in this industry. Unlevered means assuming zero debt. Alright? So unlevered beta of an average company, right, equals industry average beta divided by 1 plus 1 minus t times debt to equity ratio. It's all industry average. And from there you see, okay, on average, unlevered beta 0.5. Now we consider this Van-Shoes to see what leverage that this Van-Shoes have. And we know this company has marginal tax rate of 34.06%, and let me see, it's debt to equity ratio 9.4%. So you apply those two numbers there to estimate the levered beta for Van-Shoes when it's going for IPO, 0.54%. Right? Means there's no way you can do regression. The company is not tradable yet, right? But you look at the benchmark. You look at the comparables. When you look at comparables, I mean, those are different companies, right? But here you see, okay, what's different? Different is leverage, financial leverage. But this solution is not excellent. It's good, but not excellent because it ignored the operating leverage. Operating leverage is not in your calculation, you see? Van-Shoes may have different operating leverage than 31.16% of the ratio of fixed cost divided by the variable cost. Right? I'm sorry? It's on 201. So this levered beta is not great because based on assumption that all manufacturers of shoes have similar operating leverage, but that's not the case. So we need to consider business beta. And from the table, we see that the industry has this operating leverage of 42.8%. This is the industry average. Van-Shoes are different. The ratio of fixed cost versus variable cost, 31.16%, is different. So how do we address this issue? Well, use that business beta equation. Business beta equals unlevered beta times 1 divided by 1 plus fixed cost versus variable cost. That will give you 0.3576. That's the first. Actually, this is the first step. This is the first step, right? Yeah, going from this unleveled beta 0.58, 0.508. That is here, right? It's here. This is the unleveled beta of an average company in the industry. That's the starting point. And then you address this fixed cost, the variable cost, or operating leverage issue through this business beta equation. This is the first step. Once you get this, then you consider another leverage, financial leverage. Right? Unlevered beta. And then from levered beta, from unlevered beta, you calculate the levered beta. It's a little complicated because it addressed both issue of operating leverage and financial leverage. Yes, sir.
So you said this can be used for IPO,
Absolutely.
but also private companies?
Private company, I would say yes, but not 100% because private company doesn't have liquidity. You see, that's that's a huge difference. Private company may not meet that diversification criteria. So I would say it's the first step. Yeah. But for private company, we have to go through more cosmetic work. Yeah. But this IPO, because they are going to become another tradable company. See. But we need to address both operating leverage and financial leverage at the same time. That's why you do two-step procedure. Right? I want you to spend some time on this illustration because I think it's very helpful for you to understand how do you use this unleveled beta as a bridge, right? As a bridge to convert from one beta to another beta.
I use, first of all, market depth to equity, and then we using the leverage and the unlevered beta. Can we do vice versa, for example?
Which one are you talking about? You mean?
Another one with a fixed and variable cost. Can we calculate that one first, and then that one use on a depth to equity? Business. Why don't we use business? Why we can calculate the business first, and then use it on leverage on based on that depth to equity ratio?
Actually, see, we got a first solution here, but this solution is not great because it doesn't consider operating leverage. So from here, we are starting over again. So here we address that operating leverage first. This is the first step. Right? And then here's the second step. When we address the financial leverage, a kind of two-step procedure. It deal with the leverage, the operating leverage first. And then we address this financial leverage. Two-step procedure.
Yeah, I got it. My idea was that you use it how much you get business, calculate business, and then use it by the industry.
The business part, they calculated obviously what calculated.
Yeah.
Yeah, I think yeah after this business beta, yeah level down, level beta. Let's take a short break. Yeah. When you do problem solving, you will feel a little confused somehow, but this illustration is a great example. A great example for you to yeah to figure out this business beta level versus unlevel and the financial leverage treatment in those two equations, one step at a time. Yeah. Let's take a short break.
Sometimes you get confused when
Of course, yes. Especially this beta thing.
I was reading and reading and reading. You know, you just have to know. So I have like, I put my
Well, that's the most that you can do that. The whole idea to get as close as possible. If you get as close as possible,
Yes.
a lot. I mean, you can make money on that. And I figured another way to make sure that you're doing everything right, just put money on the table.
you want to go and you want to do it for professor.
I don't think the
Yes. Yes.
I have some questions.
Sure.
I used to do my formal questions,
Okay.
but I have some specific reports
Mm-hmm.
that I'm not sure I am doing properly. Like I made one, I don't remember question 2 or question 3.
Uh-huh.
You have an example. I make it in different ways, and I
Okay.
try to use the example that you have.
Yeah. Okay.
And one give me 5.5, the other give me 5.08, and I want to know why.
Okay.
Things like that.
Sure. Yes.
2 or 3
Yeah.
things that I
Yes.
have.
No problem. Yeah.
I'm bad. And that's what I'm trying to do.
After you.
younger than me. Imagine that after half century, you have no seeing anything.
I got contacts on, otherwise I can't see.
Okay, so as conclusion of what we discussed before the break is that we have two major approach to estimating beta. The first one is regression beta, right? But when we use regression beta or surface beta, we assume that operating leverage and the financial leverage stay the same. And also business mix stays the same as well. But that assumption may be violated for many companies. So this bottom-up beta is very useful for three types of companies. First one, company that has varying operating leverage and the financial leverage. And through a company's annual report or quarterly report, you will get information if companies are going to change that significantly in the future. And the second, for the company that has multiple line of business, it involves in different sectors because different sectors, they have different cyclical natures. Therefore, different business mix may generate different beta. And the last one is company that has a lot of merger acquisitions. So in today's financial market, especially for those large companies, like companies in S&P 500, you will see a lot of merger acquisitions. You will see company that has multiple business lines. And also company will go through very significant changes in its capital structure and operating leverage. All right, so that's bottom beta. And the third approach is accounting beta. And accounting beta believe that the market reaction is kind of unreliable on the stock market. Stock price goes up or goes down. Sometimes it follows fundamentals, sometimes follows market sentiment. So it's not that reliable. So accounting approach actually highlights the reliability of accounting numbers, accounting information. So accounting beta actually look at earnings change versus market benchmark changes to see what is the slope of that regression. Once again, it's a regression. As far as you do regression, accounting beta has limitation, of course. There's a much fewer observations that you can see, right, when you use this accounting beta. Only 4 observations a year because company review accounting information on a quarterly basis. So it's not a great method, but offers you second opinion. So that's accounting beta. It's a less useful approach, but it has certain value for you to do the double check. Now, after we address this beta, we got this cost of equity. And with this cost of equity, we can utilize dividend discounting model. D1 divided by this R minus G. Or we can use free cash flow to equity model. This is a constant growth model. Or you can do 2-stage model. Right? But nowadays, a lot of financial analysts, all those experts on Wall Street, use free cash flow to the firm model. In this case, the discount rate that we are going to use is called WACC, or cost of capital. So in order to get a cost of capital, we need 2 additional things. First one is cost of debt. And the second one is the weight of debt and equity. Debt of equity versus debt. Right? And this one's easier to fix, but sometimes people commit mistake because they used the book value. Book value of equity and the book value of debt in calculating the weight. That is not a proper way. And typically you want to look at the market value. Market value of equity versus the market value of debt in calculating that weight. Right? Keep in mind, using the market value. But sometimes getting market value for debt is a little troublesome. Right? And some people use book value of debt. It's acceptable. Why is that? Because there's not much difference between book value and the market value. If that is the case, no big problem. But for equity, you definitely want to use the market value because often you will see huge difference between those two numbers. Sometimes the difference can be like a tenfold. Yeah. Okay. What's hard here is the cost of debt. So let's say a company has just one large issue of debt, 10-year bond that they issued, right, with a coupon rate of 5%. What's the cost of debt? It's 5% because interest rate is 5%, right? The answer is no. You should never use that coupon rate as the estimation cost of debt.
It's actually less because we can write off some interest on taxes.
Yes, that's the after tax cost of debt. That's another consideration. Yeah. Before that, how do you get the before tax cost of debt? That coupon rate? The answer is definitely no. No, no, no. When you say coupon rate, it tells you nothing about cost of debt. What number should you look at? It's called yield to maturity. It's yield to maturity. For example, this is the bond. All right? Bond price equals coupon 1, coupon 2, coupon 3. Let's say 10-year bond, coupon 10, plus the principal. And then you discount. Using this is not called coupon rate because coupon rate is here. This coupon equals coupon rate times principal. Let's say $1,000, right? And a 5% coupon rate give you $50 coupon here. This one is the market interest rate, also called the yield to maturity. It is the yield to maturity that gives you the estimation of cost of debt. And how do you get yield to maturity? You need information on coupon rate, principal to get this. You need information of the bond price, which is available on the market. You need both to figure out this yield to maturity. That is the before tax cost of debt. If the company has debt tradable on the market. And many companies have many debts, many bonds, 10, 20 of those. In this case, what can you do? Some of the debt issued like 10 years ago. Some of those debt issued about 2 years ago. Some of those are 10-year bonds. Some of those are 2-year bonds. What can you do? You do weighted average. Some people do weighted average. Some bond issues are bigger than the others. Therefore, you look at individual year to maturity, and you take the weighted average. But still, that one is not a perfect one. Why is that? Because the cost of debt that we are going to use in this weighted average cost of capital would be the so-called marginal cost of debt. What does that marginal mean? Marginal means if company is going to issue debt tomorrow, what will that year to maturity look like? It could be different. It could. All right? So, yeah. So just need to take that into consideration. For example, right now, the interest rate hasn't changed yet, right? But it may increase by 25 basis points, right? Or 50 basis points in March. Although right now, weighted average year to maturity is like 5.2%, right? But if you expect that interest rate is going to go up by like 25 basis points, definitely, right? Very likely, then you probably want to add that 25 basis points in your estimation. Because this is what will happen very soon. And this is the more like a marginal cost of debt. And after that, you need to take that tax adjustment to get after-tax cost of debt, and then put that into your weighted average cost of capital equation. So this WACC equals weight of equity times cost of equity plus weight of debt times cost of debt times 1 minus t to get this weighted average cost of debt, or WACC. So you can use this in free cash flow to the firm model. I mean, this big picture is a really good picture for you to like put everything together. I mean, this is truly a big picture, but there are a lot of details addressing risk-free rate, addressing beta, addressing risk premium. All right, we have 7 tools here, 2 major approach here, right? Historic approach, implied market risk premium approach, 2 different approach. And for beta, we have regression beta, service beta, bottom-up beta, considering both operating leverage, financial leverage, business mix, right? And sometimes we may use accounting beta, right, as double check.
In terms of the project, you want that we calculate in different ways?
I wish you could use alternative methods, at least like 2 methods. Yeah, it gives you a better view. Instead of having one view, right, you want to have second opinion, third opinion. I mean, for beta, you definitely want to apply some bottom beta approach, estimating beta, not just the regression beta. Because regression beta is truly not that reliable at all. And what about a small company like a SSTK that doesn't have bond tradable? And how do you get cost of debt? Maybe not. That is like a coupon rate. Because the value of loan will change, however, it's not reflected in the balance sheet or income statement. You see, if you have bond, price changes, you know, right, the value changes. But if the loan, there's no such measure. But still, value changes, just don't see it. Right? So for the company that has no bond, what can you get? Cost of debt. And here, we use synthetic method. We use synthetic method. This company doesn't have bond, it's okay. What if its competitors have bonds issued on the market? Similar company, regarding its credibility of the company, or risk of the company. mainly the risk aspect. So we look at a comparable bonds that are tradable on the market to see what that cost of debt is, or what that year to maturity is, and then we use that as a proxy for this company's cost of debt, even though this company doesn't have debt, doesn't have bond. It might have bond, it will have bond, right? But you don't know. It's not there yet. So this synthetic approach is a very useful approach. We look at comparable companies, right? And how do we find that comparables? We look at the financial ratios. On the market, we have different bonds with different credit ratings, right? And bond with different credit rating has different default spread or different yield. And those yield are year to maturity or cost of debt, right? And let's say your company has, let's say, one of the financial ratio called interest coverage ratio is between 1.2 and 1.5. Well, then you look at the table of those bond rating to see, okay, similar company is rated as B minus, right? And the default spread is 6% back to year 2004. And then you can get the estimation of the cost of debt using this synthetic approach. So what do we use to do that comparison? Financial ratios. And sometimes you look at more than one financial ratio. And here just an example, I use just one financial ratio to see what this company fall into in terms of credit rating category. Right. If this company has much better financial ratio, then you will see if they are rated, then what a credit rating it will be. And then what cost of debt it will be. So that is a synthetic approach. And on author's website, it actually updates information for default spread for a bond that has different credit ratings. Right. So for SSTK, you might want to see what comparable credit rating will have. And then from there, you get estimation for this cost of debt. And don't forget to apply this tax adjustment at 1 minus T. Because interest payment is before tax item. For foreign company, you wanted to add another component that is country default spread, in addition to company default spread. Because company with default, but there's different two levels. For example, you're analyzing a Brazil company, right? Company itself, it has probability to fail. That is company default spread. But since this company located in Brazil, the country itself has default spread. You have to count both into your consideration. So this is once again the big picture cost of debt, cost of capital, weight of equity times cost of equity, and then weight of debt times cost of debt times 1 minus T. And also for tax rate, once again, its marginal tax rate is not necessarily equal to historical tax rate. You see, hey, based on tax code, tax rate should be the same, is that right? Corporate tax, right now it's 20%. But actually it's more complicated than that because a lot of US large companies, they have global operation. And in foreign country, it's subject to different tax rates. So eventually you want to take a look at the effective tax rate. right? So it's different from like a U.S. tax rate, like a 20%, universally the same. And when you do valuation, once again, this tax rate should not be the historical tax rate. It should be a so-called marginal tax rate. Marginal means what will happen in the near future. I mean here, okay, what marginal implies for our valuation project. We know that the Democrats control the Congress. They have initiative, right, to raise tax for corporations. Right now, 20%. I think based on rumor, it's very likely they would push towards 25%. All right. So if that is the case in a valuation project, because I mean it's gonna happen. I mean right now it's not there yet, but maybe it will happen in 1 or 2 years. And the likelihood is pretty high because Democrats control both House and House of Representatives and Senate. I mean, because they control both and the presidency, so they can definitely make it happen, no matter you like it or not. You see, right? So the likelihood is pretty high. So as financial analysts, you want to take that into consideration. So maybe right now the effective tax rate is like a 23%, right? In the future, you want to adjust that number towards 25%. Not this year, not the cash flow this year, but cash flow maybe beyond 2 years. Once it's made into the law, it's hard to change, I'm telling you. You say, hey, once Republicans take control of the Congress, they will reverse that. Well, it's hard. Just like healthcare legislation, right? Republicans don't like it, but they just cannot change it once it's made into the law. Right? So I think that concludes chapter 8, beta and the cost of capital. It's a big chapter. It is a big chapter, and I think exam 1 has lots of questions. From chapter 8, at least 5 of those, right? Okay. When you look at this equation, dividend discounting model. Right now, we already fixed this, right? Cost of equity or cost of capital. And the next one for us to address is this G. And this G is a very sensitive factor that affects stock price. Very, very sensitive. You can say, hey, growth rate for this company is 5%. Why not 10%? Why not 2.5%? Well, in the homework, it says growth rate 7.5%, right? But for your valuation project, what would be the growth rate for SSTK? Think about that. I mean, based on what you learned so far, methodology-wise, what kind of approach that you can think of to get a good estimation on this growth rate? Oh yes, historical approach. You see, it's very useful, right? But keep in mind, what happened in the past may not be repeated in the future. However, it's better than nothing, especially for company that is stable. Right? Large, mature company, right? I mean, it would be stable it was stable during the last 20, 30 years. In the future, you would expect will continue on that path. So historical growth rate give you a good indicator.
So when I was looking up mid-cap stocks and small-cap are like about 3-4 years old, not really a lot of data.
Yes.
This is the only one I found that has like 10 years worth of data.
Yes.
I want to look.
Yes. 10-year data is good. 5 years data is good. Typically, 10-year data is better because 10 years covers a business cycle. It's better, definitely better than 5 years. It has, economy goes down, goes up, goes down, right? And if your data covers the entire business cycle, the estimation would be more reliable. But right now, how long was that business cycle? 10 years? That would be 2011 to 2021, right? But actually, the current business cycle is longer than that. It starts in year 2008. The market crashed. And it's been up for, it's been like 14 years. Yeah. One of the longest economic expansion in history. All right? So, yeah, if you want to look at history, you want to go back all the way back to year 2008. When bad things happen, because after that, all the good things happen. And right now, it could be the beginning of the end of the bull market, right? So, yeah, that's the perspective.
So, so 10 years worth of data is okay. We don't need.
Yes. 10 is good. 13 is better. 13, 14, yeah. Other than that, can you think of any other method that you can utilize?
We can look by the interest. We look at the size and see how we go back to we know that there's a limited amount of customers because the humanity is expanding at a certain pace and it's not going to be more customers than it is. And if we have that many babies constantly, we don't need more diapers than we have babies. It doesn't make any sense. So it can grow as the expansion of the market. So if it takes the share of the market, and if it doesn't expand more because the market does not expand, it's limited, and it doesn't change so we'll take a look at the mature company based on that and see that.
What's your view? Just as you said, you're going to put the money on the table. Say, hey, Kevin was a good student. During the last 3 years, he got all A's in the classes that he took. So we forecast that in the next semester he will get all A's. Is that correct? Maybe yes, maybe no. Maybe next semester Kevin will mess up everything, right? So that's one thing. So as you said, if you're serious about something, you have to put money on that, put a stake on that. Make it happen. Especially for a small company, medium-sized company, they see very promising so-called addressable market. Right? That's the potential for them to capture. Right? How to capture the market. You just cannot sit there and say, I'm going to capture market. Nothing will happen. Until you put the money on the table, you do something about it. So, in addition to this historical approach, we want to look at what? Fundamentals. Fundamentals are real things that are going to happen. And regarding this growth, company has to invest. Like me, if I want to get A, I have to read the chapters, do the problem solving, I have to do real things, right? Investing my time. And it's the same. So when you look at growth rate estimation, first thing that you want to ask, where does growth come from? Where does growth come from? All right? And for example, a retailer like Walmart, where does growth come from? Easiest way is for them to open new stores. All right, expanding to, let's say, other countries, Europe, Japan, China, Mexico, everywhere. When they increase stores, what do they need to do? They need to invest. Right? And the second, if they do not open new stores, they want to make more money. It's called same store sales increase. To increase sales, what do they need to do? Increase margin is smart. Right? However, you are facing competition. If Kroger doesn't increase margin, customer will go away. You see, you really wanted to deliver value for your customers through, let's say, I'm gonna hire more people, make people shopping experience more convenient in Walmart. When you hire people, you invest. I'm going to make my shelf look better. When a customer comes in, they always get what they need. So here I want to improve the data warehouse of the company. I have to invest a lot of money in software development, logistics, everything. Trying to improve the efficiency of the older stores. It also involves investment. So in a nutshell, when you look at the source of growth, there's only one thing. You can talk about, addressable market potential or history, but history is gone. All right? Potential is high up there. In order to capture that, you have to take real action, which is just the one word, reinvestment. So it is the reinvestment that generates more reliable or feasible growth rates. All right? So that's why we have a traditional equation estimating growth, right? Actually, this G, equals retention ratio times ROE. Retention ratio equals 1 minus payout ratio. And this payout ratio equals dividend, right, divided by net income. So when company makes money, they pay out dividend. They do not pay out all the earnings, and there's something left. When they have something left, we assume they're going to reinvest so the company can grow. So this is a very conventional equation for us to estimate this G based on retained earnings. Earnings retained. Why do they retain earnings? They want to reinvest. All right. This equation have lots of problems because company may simply retain earning and do not invest. What if they do not invest? Then there will be no growth. Right? So a better approach is go beyond this retention ratio. We look at the real reinvestment. What's the real reinvestment? It's called capital expenditure. What are capital expenditures? They build they open a new store. They buy new equipment, all right? And they do research and development. And those are so-called capital expenditure because the money that they spend today is going to benefit the company in the years to come. And it is capital expenditure that will generate future growth. Right. But there's an offsetting force. What is offsetting force? Existing assets in the company is aging. They're getting older and older. Equipment, warehouse, everything. Right? So the offsetting force is depreciation and amortization. So naturally, if your stuff is getting older and you do not renew them, the company is going to go down. Your growth rate should be negative. Least that you should do is, you continue to reinvest, right, to maintain the current situation. But still, there's zero growth. So in order to have positive growth, you want this capital expenditure greater than depreciation and amortization. This is so-called net capital expenditure. It is net capital expenditure that help the company to grow in the future. And in addition to this capital expenditure, another thing that you want to look at is change in working capital. Change in working capital. Because simply putting money in those fixed assets will not make your project running. You still need to invest in its working capital, which is short-term capital, such as the money that you put into the inventory. Hire more people, so you pay more salary, right? More utility, right? And more account of receivables. Those are working capital investments, short-term money. Once you get that, project will run, then it will generate the revenue and profits as well. And that is a change in working capital. And the last item has something to do with equity versus capital. Equity versus capital, right? Because right now, you are using this ROE, which is the return on equity, trying to get the estimation growth rate. Therefore, this cash flow related thing should exclude debt. So we need to adjust the net change in debt to get so-called the total money that you invest in order to generate the future growth, and divide that number with the equity. That gives you so-called a reinvestment rate. Reinvestment rate. It is here. It's fundamental growth. Previously, we have traditional retention ratio times ROE. You retain money, reinvest. We assume that amount of money will generate the same return as ROE. ROE is a return on equity, right? And this is a return equity or return earnings. So that's a reasonable estimation of growth rate. But ignore the fact that a company may not reinvest those earnings on a timely manner. So you want to look at the real investment. So here's the real investment. CapEx, that's capital expenditure. Depreciation, amortization, that gives you net reinvestment. And then you make an adjustment on working capital, changing working capital, and changing debt. So those are reinvestment related cash flows. And then you divide by net income, that gives you reinvestment rate. It measures, okay, out of your profit, how much real money that you put in to generate future growth. And then you time this with cost ROE. Then you time this with ROE. That's one way that you can estimate the growth rate on the equity side. And there's another method that you can utilize, which is based on capital. It's a reinvestment rate based on capital times return on capital. So when you do this capital-based reinvestment rate, of course, net capex minus depreciation and amortization, and plus changing working capital. Since this includes all the capital, means debt plus equity, so you don't need to subtract this change in debt. But the denominator will change as well. Here is no longer net income, it's after-tax operating income. That's the money generated for both debt holder and shareholders. And you get this, I should call this as capital reinvestment rate. And then time this with cost of capital. Cost of capital. And in addition to that, there's a small issue. Small issue that is related to cash holding. The company has a large amount of cash. Cash doesn't generate any return. You see? So when you look at this return on capital, you should exclude cash from your calculation. I mean, return on capital equals operating after-tax operating income divided by total assets. Right? But since cash is not generating anything, therefore we need to exclude cash. So make this as operating total assets. I mean, typically you don't need to make such an adjustment if company doesn't have large amount of cash. But if it's a company that has huge amount of cash, they have to make such adjustment. For example, Apple, Microsoft, they have huge amount of cash, hundreds, billions. I mean, typically company doesn't, they don't hold a lot of cash because cash really, generate nothing for the company, right? But for high-tech companies, their business is like a cash cow, right? And at a certain time, they want to keep a large amount of cash so that they can take opportunities when those merger acquisition comes. If they don't have cash, they may not be able to buy a certain business, but since they have chunk of cash, they can buy anything they want at any time. And Apple used to have a large amount of cash, and just because they have a lot of cash, stock price actually went down significantly several years ago. And then a lot of activist investors actually convinced the company, okay, this is not what you should do because cash generates nothing. You should distribute cash back to investors. Not through dividend, but buying shares back, right? And they also suggest Apple to do it in a more aggressive way because Apple basically had no debt. They suggest Apple to take debt, right? You borrow money to repurchase stock. So what's the rationality of that?
If the price of the stock is relatively low to the estimates and the company knows that they will grow, that way they provide the return for the stockholders by purchasing back the shares. That's way they increasing the percent of the ownership in the company of the stockholders.
And also, cost of capital declines. When they take a lot of debt, because cost of debt is typically lower than cost of equity. If they take a lot of debt, this entire cost of capital will decline, which will improve the firm value. I would say, yeah, taking debt is like you are taking leverage when you have a good investment. I mean, when you take debt, the interest rate like a 3%, right? But when you are doing business, you are doing like a double-digit return. Of course, taking that will improve the value of the company. So that is a fundamental growth rate. Let me see. You will have a very useful equation here. Let me make this bigger for you guys. This growth rate equals estimated as reinvestment rate, RIR, times ROE. This is a pretty useful formula for you to utilize in your problem solving. And sometimes you have this G, you have this ROE. You can figure out what this IR is. Why is that? Because later on in your financial models, you needed to make certain estimation for this G, right? In your spreadsheet. And also you need to make this G consistent with other items, such as CapEx, cash flows. And sometimes you say, okay, your estimation of G is like 12%, but the company is not investing anything. How can you achieve that? You see, there's always balance between this growth rate and the cash flows. Because later on, when you do free cash flow to the firm or free cash flow to the firm, right? You will see CapEx, everything, right? And this CapEx should be linked to this G. And the more CapEx means higher G, but more CapEx means lower cash flow for that year. And you want to have some kind of consistency through this equation. This equation will help you to achieve that consistency, so that G is truly generated by reinvestment, not from the thin air. Right. And this IRR is a little complicated because you can make this capital, oriented IRR, and multiply this with ROC, return on capital. And difference is inclusion or exclusion of change of debt, right? And this is the kind of equity. And sometimes if you know those two items, you can figure out this ROE. And there are a couple of tricky questions, not a lot of them, just a couple, 1 or 2. In your exams, actually, you need to use this equation to figure out one of those variables. Sometimes you say, hey, it's not given. Well, can I find information for this ROE? It's not there, right? Well, can I figure out this IRR? This IRR equals G divided by ROE. It's not that obvious, you see. This ROE equals this G divided by RIR. Right. So you will use both variation to find a variable that you need. And it's not given. Hey, where can I get that information? It's missing. Well, actually you can't figure that out. Hey, where's ROE? Can I find ROE? Well, it's there. It's hidden there. It's tricky, but it's very useful. And in essence, this equation actually will help you to achieve the consistency between growth rate and capital expenditure in your spreadsheet. Yes, sometimes it's not. And even for problem solving, sometimes the problem itself is not that reasonable because you don't see that consistency. But since it's given, that's okay. But in other problems, you really want to achieve that consistency. And there's a certain relationship between ROE and ROC through this equation. If you know ROC, you can figure out what ROE is. If you know ROE, you can figure out what ROC is. There's a certain relationship between those two variables. This example, how do you get return on equity based on ROC? Let's take a look at one example, right? To see how a company can generate a growth from reinvestment. This example put all the numbers together. This equation. Right? So in year 2010, it's so old. Called the year 2004, 2005. I don't like to read textbook that has older years, but we are discussing the principles, right? We are discussing the method. It doesn't matter. You can read that as year 3010. It doesn't matter. Okay. Anyway, Coca-Cola reported. It's just the real numbers. Those are real numbers. Reported in net income 11 billion. It has total book value equity 25 billion at the end of year 2009. And the company had a cash balance 7 billion. Actually, cash a little return, not just a zero return. I mean, they have like money market instruments, right? But returns are really low. I mean, 100 million out of 7 billion is pretty low. But it's better than nothing. Coca-Cola had a capital expenditure $2.2 billion, depreciation $1.4 billion, and they reported increase in working capital $335 million. Coca-Cola total debt increased by $150 million during 2010. So your assignment is to estimate the growth rate based on information that you get here. All right. So I think what we are going to do is to get those two guys, IR and ROE. Right. So first of all, let's take a look at IR. IR equals CapEx, right, minus D&A plus change in working capital minus change in debt. That is equity reinvestment. And divide this big item with net income. So here with net income, well, yes, 11, right? Net income is there. And then where is the CapEx? CapEx is 2.2 billion is here. Depreciation amortization 1.4 billion. Change in working capital 335 million, right? 0.335 billion. And then total debt increased by 150. So here is total change in debt. So once you have 5 numbers, you can figure out this so-called reinvestment rate. Right? Reinvestment rate. And then what about ROE? ROE equals net income. Net income is 11.8 divided by total net income. I mean the ROE. Net income divided by total equity. Total equity, right? And the total equity is 25.3. 25.3. Alright. So here, since company has a large amount of cash, 25.3, but the company has 7 billion cash. So here, since cash kind of significant, right? So it does so-called non-cash equity. Non-cash equity, because those money is not generating from holding cash. The net income of 11 billion is not from holding cash. I mean, holding cash only generates this much. So you look at the operating ROE. Operating ROE equals net income minus return from cash, just a little bit. And then you look at non-cash equity. So that gives you ROE that is more operational, that has more sense of the operational assets. All right? So this ROE is called a non-cash ROE, 63.87%. Then you put two numbers together, get a 5.22% estimation of growth. It's not perfect, however, it's based on the business fundamentals. You see? Because company is reinvesting. Company is reinvesting, right? Which is greater than depreciation. It's reasonable to expect that reinvestment can generate future growth. I mean, everything is reasonable. Everything is reasonable. Can you attack the estimation like that? It's hard. You could, but it's hard. It's better than, okay, you say 5%. Feel like 10%. 7% during the last several years. I mean, this one is more concrete.
So, in the past 2 years, a lot of companies, skyrocketed, and they were not actually making money. How do you believe that kind of company if it doesn't even make money?
You mean the company stock price increase, but they're not making money, right?
At all.
At all, yes.
And the goals from zero, obviously, it's way easier to go from zero than from the.
Let me show you why. Let's say I'm building Excel model, and this is the year 0, 1, 2, 3, 4, 20, and beyond, all right? And here is sales, and here is earnings, right? Negative, negative, possibly 0, a little bit, maybe 2, right? But man, this one's growing very fast. 13, yeah, 30. By year 20, it's like a 280. And then from there, that's the constant growth model with 2% growth rate, right? And then we added up everything. You see, first 3 years is negative, like a negative 50, negative 30. Cell growth, right? And eventually, company will achieve profitability, but it's like several years later, not even 2025. It's expect to break even in 5 years. Well, since it's growing very fast, right? And we can see those big numbers. And that is story of like Tesla. Tesla stock price built on something like this. You see, it's huge. It's a huge story of growth rate imagination. I mean, people say Tesla is overvalued at a stock price of $200, way overvalued. But it went up to 400, went up to 800, almost $1,000. It bankrupt so many short sellers. Yeah, and at like 800 or $1,000, I'm not into that because I mean I do model building like this, assuming tremendous growth for next 20 years. Then by like in 20 years they should sell like 20 million cars each every year to achieve that level of sales and earnings. 20 million. What does that mean? That is number of vehicles sold in the United States for the whole year. All manufacturers, everybody, put it together, right? And 1/3 of global production. I mean, China has slightly more than 20 million, and European has a little less than 20, right? Those are big three economic entities. When you put it together, Tesla need to make like 1/3 global production. Is that reasonable assumption? I'm not into that because there are so many electronic vehicle manufacturers nowadays, right? Like F-150, they are doing electric truck SUVs. I mean, BMW, they've been doing this for many years. And China, I mean, there are several bigger companies than Tesla, like BYD. They've been doing electric vehicle for almost 20 years, And there are so many different players. You cannot count on that. 20 million vehicles sold by Tesla, just one company. I'm not that optimistic. But that's how you see stock price went up, because people are getting more optimistic on those future numbers. You see?
So they're optimistic and
and they put money in it.
Because
And people began to be convinced of their stories. See? So yeah. So yeah, you don't understand why a company doesn't have earning and stock price went up like crazy. But some of them may be sustainable, others may not. Like Amazon, I mean, for years, they don't have any profits at all. Amazon, but stock price keep rising. Yeah, it's amazing.
but they never went down in 2000 all the way to 6 bucks,
Hmm
80 something.
I mean, people just see those numbers getting bigger and bigger. Yeah. Not here, yeah.
Yeah, so
People just ignore negative number here, yeah. They focus on here, yeah. But anyway, I mean, it's the valuation principle, yeah. All right, I think that's all you need to understand for today. And after the class, you will have one serious chapter here, with actually 2 chapters together. Online lectures from earnings to cash flows, 2 chapters, and then terminal value, a very small chapter. All right. Click on the video link. You can see, yeah, some explanation. To estimating terminal value and the previous value. And then first exam. Yeah, first exam. 10 questions. First 3 are very easy. Yeah. Couple of those pretty time consuming, especially the beta one. And there's a one question about beta pretty complicated. But yeah, spend some time. Yeah, take this as opportunity, not just as a burden of the class. I'm gonna take this opportunity. Yeah, train myself a little bit. Yeah. Any questions? If not, I'll see you next week. Next week, before your class, before Thursday, ideally Wednesday, let me know if you just cannot complete the first exam. Yeah. So, I'm on first question right now. I cannot submit on Thursday. If I see that as a major trend, again, I may give you a couple days of extension. But I think first one, you should be able to do that. Yeah. In the meanwhile, work on your stock valuation. I think for valuation project, by now, you should be, let's say, hey, this SSTK, right? SSTK stock, you should be able to get some most recent information. From here, from Google Finance, Yahoo Finance, you see some history, everything, and from Capital IQ, you will use Capital IQ very intensively for later weeks. But right now, I want you to navigate it to see what kind of information you could get, right? But it's not the focus. And right now, I want you to get into the most recent quarterly report and the most recent annual report. How do you find that? You go to so-called investor relation. Investor relations. Every company has a website that hosts investor relation content. And from there, you want to look at quarterly report. Typically in, let me see, SEC filing, earnings release, should be earnings release, annual report, 2020 annual report. Yeah, very nice. but it's long, 100 pages something. 100 pages something. And how do you read the annual report like this? There is a feasible way for you to get into the core part of this annual report, because your purpose of reading this report is to understand what company is doing, right? And what company is about to do, especially because later on you want to estimate growth rate, right? You want to pay attention to their reinvestment, right? Reinvestment, the earnings, ROE, so on and so forth. And one particular place you want to look at is management discussion analysis. Yes, this is very useful. Yes.
I see that in the company, but I was reading also what they report to the government, to the
SEC?
website. And what do you want? That we base in that one, or we base in the what they really report in the management, and they say what they do with the investments, what they all the information.
Yes. This is the file that they file with the SEC. Yes, it's kind of required filing. They have to do this on an annual basis. And for the other than annual report, you want to look at its quarterly report. And let me see, earnings. You say earnings release. Earnings call. Earnings call transcript. Earnings call transcript. It's like a recording of the meeting where company released their earnings. Let me see. It's on Seeking Alpha. Yes, transcript. You can look at a transcript. It's like people are talking. And other than that, financial analyst actually asking questions. You will see that. That's a quarterly report and annual report. So after that, you will have very good understanding of what company is doing, how we are doing it, and what the future looks like.
Do you also want us to do a SWOT analysis before we go over it?
SWOT is more like, it's qualitative thing. You could do that. It's a plus, yeah. But it's not a kind of required thing that you have to go through, because here I think two layer of analysis that you have to do is historical one and peer analysis. Peer analysis is like horizontal, and historical one is kind of vertical ones. Yeah. That's very typical for any stock analysis or stock research. And the goal, no matter what kind of analysis they're doing, is for you to get